Hello, all. Thank you for joining us today. Wishing you all a merry weekend. This webinar will be taken by Nakul Janakiraman and Vinayak Kumar, financial planners at iThought. They will be applying the winning strategies of the much spoken about, much talked about Indian Premier League in financial planning. Without further ado, let me cordially invite the presenters to take over. Thank you.
Hello, all. Thank you for that lovely welcome, Tarun. Thanks for joining us on this lovely Saturday afternoon. Hope the weather is to your liking. I'm sure the sun has come out. So today, right before the eve of the IPL finals, we have a webinar where we kind of dive deep into what makes the IPL such a spectacular sport. Just to, there is cricket and there's IPL, right? So it has its own fans, it has its own kind of fan following around it. So what has made this behemoth so big? And in contrast to that, we'll kind of take into other aspects of finance, compare it, use it as analogy to compare it with other aspects of your financial life so that we can make it big just like the IPL did. So without further ado, I would like to introduce my colleague as well, Vinayak Kumar, who's a fellow financial planner, who will be joining us on this webinar as well. And without further delay, I'll move on to what is the agenda for today. Okay. So to start with, everyone wants to score an 100, right? That's what the game is all about. We've seen what Riyan Parag can do. We've seen what Virat Kohli can do. We've seen what Ruturaj Gaikwad can do. But how do we, as ourselves, score centuries in our financial game plan? This is where the definition of a century becomes very, very different. So that is what I would like to start with. See, comparing ourselves to different to other people's financial goals becomes very, very hard for us to manage. You might have a financial goal where you would want to take a something like a yearly vacation. I might have a financial goal where I might say, okay, 10 years later I want to maybe retire early, 10 years later maybe I want to buy a house. So each of our financial goals differ. So achieving our financial goals is what we equate to centuries. So a century will depend on what you want and what I want. A century is not something that is common. A century will be dependent on your lifestyle needs, my lifestyle needs, your ambitions, my goals, and so on and so forth. So setting your goals right and going for them is much more efficient than looking at other people and forming your goals based on what they want to do. That is what the exercise of financial planning instills to do, where it is based on your goals and your goals only. Financial plan is crafted to do what you want to do and not to mimic what other people would want you to do. Okay, super. So we'll be looking at some very, very important aspects on this financial planning journey. So first is having substitutes and impact players. So IPL introduced a very, very entertaining concept of impact players, players who can come in, players who can be substituted. This can be batsmen, this can be bowlers, so that you have an extra batsman, you have an extra bowler to kind of help it. So where does this extra come in your financial life? Second is uh, the negatives. So you have wides, you have no balls. You obviously want to avoid these extras, right? If you bowl a no ball, it's a free hit. It's a free hit. It can go wherever you want. If you bowl a wide, that's again a run that's being given away. So what are those negatives that is just being given away in our financial life? Third, scoring centuries and taking wickets. Again, as prefaced, these will be on your financial goals, what we want to do and how we want to go for it. Don't worry, we'll dive a lot deep into those. Number four is a strategic timeout, measuring the progress towards your goals. So, setting a goal, having investment towards this is good. Measuring the progress is equally important, because only when you measure it, you'll know where you stand, what is the shortfall or what is the surplus that is associated with this goal, and what you or I should be doing so that we kind of bridge that shortfall, bridge that surplus. And more importantly, how do you do this? How do you bridge the shortfall? How do you bridge the surplus? If there is a kind of a limited way to kind of go about this, what other alternatives can there be looked at? Fielding position plus having a good captain. So this is where an asset allocation comes in. A good captain, a good kind of captain can set your field. And when your bowler or you as a player bowl towards the field, that is where your asset allocation is set. catches and stumping. So this is where the concept of investments, mutual funds, SIPs, stepping up your investments, these kind of things kind of roll into place, where these are pivotal moments in the game where you kind of capitalize on these so that you can kind of move on to the next stage of the game. Last is victory. Everyone wants to retire nowadays. People wants to retire early. After retirement, what you want to do is always up to you. You might want to start a business, you might want to go on a vacation, you might want to take it in a chilled out manner, but again, having the option is what a financial plan aims to do. Okay, super. Now we start with a very, very important topic, that is having substitutes or having an emergency reserve. So having impact players is one of the kind of aspects where IPL kind of really excel. It kind of makes your game entertaining. But in contrast with it, having an emergency reserve is often a boring thing in your financial journey. Because if you have things like, let's say you have a monthly expense of 10,000, you should ideally have an emergency reserve of 6 to 8 months of your expenses, which is usually 60 to 80,000 or maybe a lakh. If you do have this, there is a general sense of, okay, even if I do lose my job, I have the next year or next 6 months of expenses covered so that I can kind of go and search for this. You can kind of you can kind of contrast the things of an IPL where even though CSK do have a 11 or a 11-man lineup, there's always a healthy kind of range of substitutes where if someone does get injured, just like Deepak Chahar did, just like Devon Conway did, there's always a kind of 5 or 6 other substitutes who are ready and raring to go, just like in the case of Team India as well. So any team having an emergency reserve is crucial. So even if you look at it, the World T20 squad, the first thing that Team India does is they kind of reveal the squad as well as the reserves. So first thing that someone like us should be doing even before we kind of start our financial journey, even before a team kind of goes on to play their game, is having this reserves in place. How to build the reserve? Now where to build this reserve? This is essential. This is very, very essential. You do not build your reserve in very, very aggressive instruments where, or very, very growth related instruments where your capital is put to kind of your capital is exposed to risk. So you build this in traditional investments. You build this in fixed deposits. You build this in RDs. You build this in debt mutual funds. You all or you just forget about all these and you just build it in a separate bank account where you do not have access to it. Maybe turn off UPI. Maybe turn off net banking. Where this bank account is just for emergency, just for things that you want to access to it. You never access it. You do not have a card for it. So that is also another way. Having a short-term FD or a short-term RD also works because the return is not really the point here. The point is that we have something in place. Yeah. The second one, we're going for the DRS or the Dhoni review system. Term insurance and health insurance are crucial, and I'll make it very simple. That's all the insurance that you need. Just like, when you're not sure, you go for a player review for an LBW, a player review for a catch, or maybe a player review for a stumping. That's where your insurance comes in. Your insurance is your first line of defense. So that, okay, I'm not too sure I'm out, I'm going to use my insurance. I'm not too sure I'm out, I'm going to use my one of the DRS reviews. So that is where term and health insurance comes in. Having a good health insurance, maybe 5 to 7 lakhs per person. If you have a family of 4, then at least have a health insurance cover of 20 lakhs so that it's 5 lakhs per person. So that is very, very important. Term insurance, determine how much your human life is worth. A human life is worth much more than you and I think it is. For example, let's say you earn a lakh a month. The future value of what you earn in today's value might be a crore, might be a couple of crores. If you add into things like your financial goals as well as the loans and outstanding liabilities that you currently have, this 1.5 crore might become 3 crores or 4 crores. That is the ideal cover that you should have. Maybe not today, maybe not tomorrow, but over a period of, let's say, when you're young or maybe when you're 30s, you should achieve to get this term insurance cover so that when something happens, the DRS can come into play, the insurance can come into play. Yes. Now coming into a very, very controversial topic, that is the wides, the no balls, the free hits. The first one is ULIPS. Why? So what are these? ULIPS are basically insurance products where we combine insurance and investments. So that is what an ULIP is. ULIPs are often characterized by 5-year lock-in periods and a lot of charges that are often hidden from investors. Though they are coming to light today, still paying a 4% or a 5% yearly charge for an insurance come investment policy that does neither is often inefficient, to put the least. So these are policies where you stay clear. Now you might ask the question, what happens if I'm in? How do I come out? Unfortunately for ULIPS, this is a 5-year lock-in. An investor cannot do much here. So the maximum you can do is kind of, if you're in maybe in the third or the fourth year, pay the rest of the premiums and come out of it as soon as the policy matures. If you're someone who's just started, unfortunately, if you do stop paying the ULIP premiums, your policy can be moved to a discontinued fund. Of course, this will depend on a policy to policy. So, do reach out to us. If we'll be happy to help you in this regard as well. We do have insurance experts in-house who can help us out as well. But ULIPs, stay clear of them, avoid them. For an insurance, get a health and term. For investments, there's always mutual funds. There's always other investments where they can help you grow your money a lot better. Whole life endowment. So just like the saying in cricket, if you bowl a no ball, you get a free hit. This is where a whole life and endowment is. But instead of just the free hit being the next ball, with the whole life and endowment, this is going to last you for the next 10, 15 years. So that's how these policies work. You start paying premium for 5 years and you receive benefits for 10 years. But often when we do calculations for these kind of things, we come up with returns in the range of maybe 6 to 7%. So an FD can give you that. So this is where people are kind of allured by the notion of safe, reliable returns. Kind of forget the point of inflation, forget the point of how fast expenses are going, and investment is not an option but has become a necessity over the years. So do avoid these. If you do have something in place, review them before you take a decision on whether you want to surrender them. Maybe they are too close to kind of maturity where it doesn't make sense to surrender them. So yeah. Again, circling back to insurance, traditional insurance policies often cost you a lot, LIC and things like that. Since they kind of offer you a fixed amount of return, they have to cost that much where they can kind of provide you that return. But if you just go for a term insurance policy, yes, you do not get anything back at the end of the period, but that is not the point of insurance. The point of insurance, just like a DRS, is that we are not getting extra runs out of it. That's not the point of DRS. The DRS is there only so that I can kind of review it once. I can make sure that I can use the review to check if, okay, is this out, not out, or maybe an umpire has made a mistake. So this is where a term insurance comes in. Term insurance often provide you a lot more cover than what a traditional insurance policy can ever provide you. Now, to sum it all up, I just want to take you guys through one small example. So let's say an insurance policy is getting marketed to you. Let's say it's a whole life or an endowment policy. You pay 22,000 per year for 12 years. You get 3.5 lakhs on maturity. So what the insurance kind of markets is it's a 12 times return guaranteed. Now that does seem very good, right? You do also get a life benefit of 3 lakhs in the case of any death benefits. Now let's see how this works out when we do the calculations in an Excel worksheet. Now, these might look very complicated, but I just want to draw your attention towards the yearly kind of payouts where you start at 33 until age 44, you're making the premium payments, and the maturity value, you get close to 3.5 lakhs in maturity value, and there's also a bonus that's getting built up. Now, if you look at the XIRR return of the policy, it is just in the 4 to 5% range. Paying 10, 12 years of premium to get a guaranteed amount on maturity just to get a 4-5% return is not what an insurance should give you, because the kind of death benefit that you get from this policy is also minuscule than what your life will be worth, because your life is worth a lot more than what these policies can even quantify. So stay clear of these policies. In the case that you do want to surrender them, if you do look at it, you do get 30% of all premiums paid minus the first year premium. So let's say you pay for 5 years. That means the total policy premiums of 4 years minus the first year premium times 30% is what you get. So the surrender value is one thing where people are often stuck where if you're 4 years or 5 years into the policy, they just want to continue and get it over with because they are also not in the wrong. Because at that time, coming out of this policy is a lot more kind of difficult because you put in a lot of time, you put in a lot of capital, and losing that initial capital is often hard. So if you do have these policies, always review them. If you do not have them, stay clear of them. So just like there is one or two kind of bouncer warnings per over, in your financial plan, unfortunately there is not things like that. So I've seen people with 15, 20, 25 ULIP policies, 10 LIC policies, a couple of small cases, and a portion of their capital they've given it to someone to option trade. These things, always stay clear of it. Wealth creation takes time, your financial plan takes time. Virat Kohli didn't become Virat Kohli in a day. It took him 4 5 years under the under 19 team to play, becoming captaining it, winning it, and then transitioning to the Indian team to do it all over again. So this takes time. That is how wealth is built. That's how runs are scored. You do not go into a test match saying, okay, I'm gonna score a 50 ball 100. That's not how it works. It takes time. You do not throw away your wickets in the allure of quick runs. So that's where these bounces kind of come in. Staying clear of this, ducking is with what you should be doing. Maybe not pulling every bouncer out of the field is something that we do not recommend. Now, moving on to your financial goals. These are milestones, just like your 50, let's like your 100, just like a double ton. These kind of goals are very, very pivotal. You have things like your kids' education, or maybe you want to upskill your own education, marriage, of course, asset purchase. This can be buying a car, buying a house, buying a plot. So whatever you want your asset to be, and of course, retirement as well. Now, I want to walk through a small case study. You meet Ankit and Neeta. Both are married in their 30s. They were keen on growing their family. Maybe they want to have a kid or two. They've also, in the pursuit of better salaries and a better career, they moved from Lucknow to Bangalore for work. The aged parents now live in Lucknow. Ankit is an only child and worries about his parents' wealth. This is often the case where when you move away from your parents and in your 30s, parents usually often experience a kind of a thing where their health begins to deteriorate. There's a cycle of life continues. Now, let's say there is a situation where his mother had a fall and needed a hip replacement surgery. This year, his father also needs a cataract surgery. What is the best way for Ankit to support his parents? Now, even before you kind of start building your dream, if kind of things like this kind of happen, this kind of derails you financially as well as more importantly mentally also from your kind of financial plan. So how can you address it? First, if Ankit is working in a corporate, always have your parents enrolled in the corporate plan because that is often coverage from day one. Second is have a kind of cover that even if it is expensive, have at least a cover in place for your parents. Maybe that's not a very extensive cover, but having a cover in this aspect helps. Third, if these two things are not possible, then third, you'll have to manually build an emergency reserve that is maybe a 2 lakhs or 5 lakhs or 7 lakhs, dependent on what you want to do. If when you have this in place, then go for investing towards your other goals because a goal like this, it is going to impact you mentally. Now, it should not impact you financially as well. So you going into debt is not what your other financial goals need at this time. So having the reserve is very important. But even more than that, what I've seen is most people do have the corporate insurance place. Going one step above and getting a senior citizen insurance policy for your parents is probably the next step. Now, these are some of the things that we talked about, and these are the things that are outlined in the points as well. Setting up a medical reserve for their parents, consider hiring a caretaker. Of course, that is also an option where if we are young and we are professionally away from our parents, this is true for NRIs, this is true for Indians, this is true in all aspects of life. You should check for a comprehensive and affordable health insurance policies. And often I understand that if parents have some pre-existing conditions like hypertension, some diabetes, having health insurance policy becomes difficult, but this is not something that is not possible. Yes, the premiums are a little bit expensive, but if you have a policy and if you stick it out for maybe 2 3 years, the pre-existing condition waiting period then waves off. So having it as soon as possible is something where it'll give you a lot of financial stability. Purchasing term insurance and name parents or your own spouse or your own family as beneficiaries is again important, because let's say you have a home loan, let's say you have financial goals for your family that you want to meet. Let's say you are only the sole earner. So having a kind of term insurance that pays off in your demise is equally important. Now, moving on to the next slide, education and how much does it cost. Again, this is a goal that is again equally important. See, if you have a child, do you want to some of the questions that you should ask yourself is, do I want to send my child to a CBSE school? Do I want to send him or her to kind of an international school, maybe an ICSE program? So what do these cost me? So usually a CBSE school 1 to 2 lakhs per year, on the higher side. If you want to go for an international school, that's usually 3-4 lakhs a year. So that becomes very expensive. How much does it cost to complete an undergraduate degree in engineering in India? Again, this is something where 4 to 5 lakhs per annum or 20 lakhs is often expected. This is without considering scholarship. Again, now the third point, coming to a very, very important point, completing an undergraduate degree in medicine in India. If of course in public colleges this becomes very, very affordable, but in private institutes this is going to cost you a fortune maybe to enroll someone here. So how do you plan for this? Complete a PG degree in the US. How does someone do it? How do you yourself do it? So this is where financial planning kind of comes into place, where maybe taking a loan for all of this is something that can be considered, but not that should be considered all the time, because this is going to put you in a place where just out of college your child is going to be burdened with a lot of EMIs, where they have to work and they do have to find a job where over the next 4-5 years a lot of their savings is only going to go towards this kind of thing. If you're someone who's looking to kind of put your child through a school, a lakh or a lakh and a half a year of kind of school fees is something that is daunting, and this is going to only increase. Inflation is going to play a vital role, where when they are in their 10th grade or the 11th grade or 12th grade, you're probably going to be looking at 2.5 lakhs. So how do you go about this? So you go about this in a place where each month a portion of your income should go into a combination that is designed as per your asset allocation, so that a part of this can go to safer instruments, a part of this can go towards a goal where we are allowed to take some risk towards your higher aspirational goals, towards beating inflation, and part of this can maybe go towards other kind of commodity like instruments where we kind of smoothen out this volatility. This is where asset allocation becomes pivotal. This is where having the financial goals in place and having a roadmap in place becomes even more pivotal. For a degree like post graduation in the US, you're looking at something like maybe 50 to 80 lakhs. Maybe not all of this is something that you want to fund. Maybe 50% or 25% is what you want to fund. However, that might be, maybe starting as soon as your kid is born, even with something like a 2,000 or 3,000 per month, is something that can, over the next 17 or 18 years, put into instruments where they're allowed to grow, can net you a pretty sizable corpus. Yeah. Now, on to the next segment, I will be passing it on to my colleague, where he'll be talking a lot more on, just like Bumrah is here, taking wickets. These are key milestones where, okay, now the goals are set, and we've looked at some of the questions that we should be asking ourselves, because only when the questions have been asked, we know the answers. We can kind of move on to things where, how do you achieve these milestones? How do you go about them? So I'll give the floor to Vinayak, who will kind of take you guys through the rest of the webinar.
Thank you a lot, Nakul, for a great start on the first innings of the strategies of the IPL game. So right now we are going to move on. Let's focus about the strategies. It's like that are going to help you build your financial goals and so on. So it's like, why is taking wickets something similar to achieving your milestones? Nakul, the previously. Yeah. So it's like, as per a data point that I had received is, it's like an average IPL bowler takes a wicket every 24 balls. So in that, similarly, just like every wicket that falls in an innings, set smaller achievable targets or milestone on your path, so that it's like it can lead a big part towards your financial goals. And one important thing that we don't do is we need to celebrate each milestone. It's taking a crucial wicket and moving closer to your victory. So right now we are going to focus more about the asset allocation and strategies, and it's like few case studies that might actually help you out in thinking about your financial planning goals. Yeah. So strategic timeout. It's like why a strategic timeout is going to be important. So one thing is okay, annual review to see your investments and saving amount adequate, course correcting your goals regarding investments and so on. Yeah. So one thing is why a strategic timeout is there in the IPL game. So IPL captain calls out a strategic timeout to assess the game and make adjustments. It's like if any new strategy has to be implemented and so. So hence, it's like what we recommend you is you need to also take out strategic timeouts to review your financial plans. So it's obviously financial plan is going to be a one-time thing, but it needs to be reviewed regularly because there are going to be a lot of changes in your lifestyle, your cash flow, and so. So hence, based on your lifestyle situation, your goals need some tweaking, right? So a timely review can help you adapt to your financial earnings and actually stay on track. So hence, strategic timeout is something similar to reviewing your financial goals on a timely basis. Yeah. So, okay, what about batting form? So it's like just asking our existing attendees, it's like thinking about a financial batting form. What would you describe yourself as? A steady accumulator that is a test match style or an aggressive power hitter, something like a T20 style. Or else there would be third person, something like a balanced all-rounder. So one thing is it's like each and every batting form is different and it's gonna be different and suiting to a specific person based on the risk capacity, the tenure and financial goals. So I guess someone has dropped a reply. Oh no, yeah. So one thing is it's like why having it's like a similar approach in your financial plan is going to be important is it's like when you're starting out and when you're in your 20s and so on, like the first initial power play hitters, it's like you need to save aggressively for your short term goals so that it's like in the meantime you will be able to build the financial assets so that you can build and accumulate towards your financial goals that are on the long term, like your retirement goal, inheritance, children's marriage and so on. So right now we are going to find it's like more about the right balance and what would be the strategy to bring the balance in the entire asset allocation. So yeah, let's see a case study next. Okay, so talking about the asset allocation. So there are plenty of asset allocation that is there in the it's like market and so on, like cash and equivalents, gold, silver, provident funds, real estate and equity instruments. So cash is gonna be a chunk where it's like you are gonna build your emergency reserve. So ideally, according to our financial planning thumb rule, it's like 6 months or 1 year's monthly expenses need to be kept as an emergency or contingency reserve. Why having an emergency reserve or contingency reserve is going to help you out would be, suppose for example, if you have started your investments in equity and other things, if there's an emergency or contingency that pops up, you might go and touch the equity instruments and actually hamper the compounding. That's going to affect the long-term goal. So in the meantime, what you can do is you can start building a separate emergency reserve, something like a cash and equivalents, like short-term debt instruments, FD and so that it's like in case if there's any contingency, you can make use of the contingency reserve. Second, gold and silver. Why having 5 to 10% of your total asset allocation allocated in gold is important is one thing is it's a huge inflation hedge, and apart from that it's also a portfolio hedge. One thing is it's like okay, let's say it's like as I'm 20 years and so right now maybe 80% of my allocation might be in equity, but I would need a plenty of good amount of 10% of 20% in gold and debt funds. Because it's like if you are going to see in the next screen, it's like it's not like equity is going to outperform every year and so there needs to be a proper balance in your entire asset allocation. So hence having 5 to 10% of the total net worth in the gold and silver commodities would be great. So it's not necessarily having it in physical gold and so there are other investment avenues under gold itself, like something like sovereign gold bonds, gold ETFs, gold mutual funds and so. So based on your financial goals, you can structure it in a better way. So one example would be, suppose let's say if you have a marriage as a financial goal in next 8 years, you can start contributing to sovereign gold bond and buy a big chunk of sovereign gold bond now, so that in 8 years you would get a great value. So whatever it's like as per the SGB rules, if you're going to hold that specific sovereign gold bond for next 8 years, you will be completely not paying any tax on the capital gains and so. And it's like if you see the recent data for the last 8 years of the SGB compounding growth rate, it's somewhere around 20% and plus. So hence it's like equity is not only the one deciding factor that should be in your portfolio, there should be an exact split in the asset allocation. Apart from that, it's like involuntary, we are also contributing towards provident funds. So one thing is it might not beat inflation in the long run, but one thing is for your retirement and every other things, it's going to provide a proper balance in your portfolio. Okay, suppose let's say it's like right now you're contributing 12% of your salary into employee provident fund. And you might have somewhere wished it's like, okay, if I could actually contribute more, I could actually make use of that safe government saving 8.1% return, right? For that, similarly, there's another investment avenue called as voluntary provident fund, that is VPF. So you can actually reach out to your HR and financial manager in your company and ask them to set up a VPF account to you. In that case, you will be able to contribute. It's like whatever maximum you can from your monthly savings and cash flow. Apart from that, real estate. So one thing that I would like all to know is, okay, the function of the real estate property needs to be financial and emotional security. You need a house to stay, right? Apart from that, it's like for your financial goals, maybe children's education, retirement, marriage, and even other goals like personal development. One thing is we cannot map your traditional assets towards your financial goals. Why would we would hold a emotional attachment for that specific asset class, and also these are not that liquid. So hence we need to build financial assets towards your financial goals, but having a real estate for your stay and etc., it's actually perfect. But as an investment wise, we have to rethink. It's like, okay, it depends upon areas and a lot of factors. So hence, having a proper mix in your asset allocation is important. So not more than 40 to 60% of your total net worth in real estate is recommended. And also, yeah, equity instruments. So longer your horizon and based on your risk capacity, you can have a good allocation into the equity mutual funds, stocks, and other investment avenues and the equity instruments. So this would be a broad picture about the asset allocation. Yeah. So as I said, it's like if you think it's like, okay, I'm going to just invest in equity and for a long-term horizon, okay, it's like a 10 plus year horizon, equity has given 10 to 11% and so on. But if you see for short-term goals, like 5 to 6 years down the line, you need to have a proper asset allocation balance. So if you see, it's like large cap has not outperformed every single year. There has been gold sometimes up, small cap, international fund, even government securities is something was up in the 2016. So hence, it's like proper mix of asset allocation is required in your total portfolio. And that asset allocation should be a decider factor on your financial goals. So based on your financial goals, your asset allocation needs to be revised. So that would be this specific built on the multi-asset investing. Yeah, so exactly what works for you might not work for other, right? Because it's like one shoe would not be like fit for all. That wouldn't be the case in the financial planning. So let's see what are the questions that you need to ask yourself in the financial planning exercise to get more clarity about your current position. Right. So personal finance is pretty personal, right? So we need to figure out who are our dependents. It's like even if you want to save it towards your financial goals, like Nakul explained rightly in his case study, it's like when we are dependents, we might need to set up a separate reserve for them. If they are senior citizens, we need to build a separate medical reserve because the health insurance is going to be more expensive. How long do you need to support your dependents? That is one thing, considering the life expectancy and so on. What would you like to provide for them? It's like one thing is it's like monthly income is the only proper safety that it's like we can actually help our dependents would be with. And apart from that, also one thing is, as he said, risk management. You need to be properly insured, and you don't need to be underinsured, because if any unexpected situation happens to you, you don't want your dependents to be left with nothing. So hence, you need to be insured. It's like you can reach out to an insurance advisor, and it's like figure out it's like what is your current insurance policies and so on, and review the same. What are your aspirations to? So it's like a lot of pretty investors that who start young, it's like they just invest. But one thing that I would recommend is it's like you actually sit down, list down your financial goals, and then you figure out what are your priority in meeting each of the goals. And then it's like start investing towards a specific goal individually. And apart from that, which career stage right now are you in? So it's like earlier, the better is always what we hear. But one thing is it's like when we are early, starting early and investing, we don't have any big commitments that we have in our life. Like, but once we start a family and so 30 plus and 40 plus, it's like there are going to be more commitments that come in, like children's educations, family expenses, and so on. So it's like when you're in the early stage of your career, it would be a right time to save high and invest high towards your goals. And obviously, how much risk can you afford to take? It's not like, okay, let's say I am 40 years old, I'm going to retire in 45 or 50. I didn't save or build any financial assets. I just have 5 years to build. That doesn't mean I'm just going to lock in and go and lock in my money into small cap or mid cap mutual fund just because they're going to give high returns. But you have to figure out if they are going to be high risky and high volatile too for a shorter period of time. And that is one thing that you need to say. It's like, and how much risk you're willing to take. There are plenty of risk questionnaire. It's like link that is available on the website. You just need to fill a 10 to 15 questionnaire. That is going to let you know, it's like, what is your exact risk capacity? Are you a moderate investor, aggressive investor, or a well-balanced investor? So that also can let you know, it's like, okay, this is my risk capacity. I should stick with that. Then I need to plan my investments and invest towards my financial goals. So yeah. Okay, so apart from that, why rebalancing and review is important? Capturing new opportunities, protecting profits. It's like, suppose, for example, it's like you are a global investor. You had invested in, let's say, S&P 500 ETFs and so on. It's like last year, and you had a good bull run in the same. So what would be the right thing to do is book profits and shift to other investment avenues and asset class. And that is one thing. Apart from that, capturing new opportunities. There are plethora of investment avenues that are available in the market. You need to see which maps towards your financial goals and review the same and actually capture the new opportunities. Right now, if you see in the market, it's like equity is one thing. Apart from that, debt and bonds are also something that you can explore, because it's like, if the right now the yield is also very pretty and like impressive. So if it suits your financial goals, you can surely considering adding bonds to your asset allocation and so. So next would be, so whenever there's a cyclical change in the market and so on, you can change your and review your portfolio. Apart from that, so let's say it's like I feel started with, okay, I'm already near close to my retirement and I just want 50% of my allocation in towards the equity component. Let's say if that target return is exceeded and so, then you can actually rebalance your portfolio again. So that is one thing. So also I would recommend is it's like, even if you're starting out, you don't need to sit and regularly, like daily, on a daily basis, monitor your portfolio. It can be done on a quarterly, half yearly basis. And whenever there's an opportunity, obviously you would also be updated by your financial advisor what next can be done. Yeah. Yeah. So that's what I was saying. It's like you can actually do it on a quarterly basis or a half yearly basis. That is one thing. And it's like you just need to align with your investment horizon. So if your retirement is 10 years down the line, stick to your investment avenues, remap it. When you're closer to your retirement, 8 years and so on, etc., then you can actually rebalance your portfolio. Yeah. Okay, so this would be one interesting and exciting case study that we're going to look at. So I guess it's like tomorrow the final would be there, and it's like, let's see, SRH or KKR is going to lift the trophy. But we have to figure out, it's like, one thing is, imagine how comfortable it is as linking a retirement as lifting the IPL trophy. So hence, we need to devise strategies to reach the financial independence and actually celebrate this personal victory. So one thing I would say is, it's like, we can move on to the next slide, Nakul. So we'll actually start with a case study. Assuming a current age of 35 and the retirement age being 60, still another plenty of 25 years of conventional retirement plan. So expenses as per now is 1.2 lakhs and inflation being 6%. Let's see what next he has to do. So how much would it cost for him to retire would be, the retirement corpus adjusted for inflation would be exactly 11 crores. So this can be achievable with higher savings and etc., because it's like inflation is going to heat up your returns if you're going to just lock in and be very traditionally investing in recurring deposit and fixed deposit. So there is 25 years of the tenure, and let's see, it's like what are the strategy that the person needs to do to reach the milestone. Correct. So it's like, one thing is we have to build a portfolio of investments. So it's like, as I said, in fixed income, there are plenty of other options like deposits, government saving schemes, debt mutual funds, and corporate bonds, and so on. So based on your financial goals, you can pick one from the same thing, and whatever is there and currently relevant in the market, and whatever is in the right opportunity, your advisor is gonna always recommend you. It's like what is gonna help you and suit your investment portfolio. Apart from that equity, there are investment avenues like stocks, equity mutual fund, structured equity instrument like portfolio management services is one thing. And in precious metals, as I said, it's like not only physical gold, there are RBI sovereign gold bonds, gold mutual funds, ETFs, world mining funds, and so on. Apart from that, for sure, it's like global investments, direct stocks, fund, and global ETFs. So it's like you might ask, it's like why global investments might help you out, setting up an account, and so might be a cumbersome task. But why global investments might work out for you? Let's say it's like 5 years or 10 years down the line. If you're planning to send your child abroad for his global education, like masters and so on, at that time, this global investments would be the right thing to pass on and can be used for the specific goal because it's like comparatively the inflation there is going to be 4% and so on. Apart from that, it's like when we do this global investments and set up account there overseas, it's like one thing is the currency exchange and all the cost needs to be on the limelight. We can actually compound a good wealth in the global portfolio over a long period of time. Yeah. So yeah, I would talk a bit about what are the advantages of mutual funds. So suitable, it's like it is suitable for different varied of clients and investors. It's like based on their investment size, corpus, their risk capacity, and so on. Apart from that, this would be a right strategy to diversify your investments. So let's say it's like you have started out investing and you're just directly investing into direct stocks. The exposure in the specific stock is going to be on a higher level unless if you're a proper research analyst and so on, you won't be able to track the fundamentals and so on. So apart from that, it's like one thing would be for the diversification part, mutual funds would be right thing. And also it's very liquid. So there's no specific lock-in period and so on, except TLSs, that is a tax-saving investment saving scheme. So it's well regulated by the SEBI, the Security Exchange Board of India. And as I said, it has very different variety of options. Like for all the different financial goals, there are different variety of options. For your short-term emergency reserve, there is short-term debt fund. For your medium-term goals, there are medium-term funds and debt funds and etc. And obviously for your long-term goals, there are equity mutual funds and different variety of themes and market caps and etc. And one main advantage of investing in mutual funds would be discipline. So the monthly savings. Once we start an SIP, just stick into it, scaling it up whenever we have a hike and etc. and so on would be the best strategy. And it's also very flexible. So you don't need to just start with a monthly SIP and so you can also start with the lump sum amount and gradually scale up your portfolio whenever there's an opportunity. So hence, these are the few advantages of mutual funds that I wanted to like tell you guys. Yeah. So what are DIY investing pitfalls? One thing would be focusing only on the past performance. So it's like, let's say it's like one thing is already overvalued and you're focusing on a specific mutual fund that has already reached its peak. One common mistake the investors do is actually they would fall a prey to just seeing the past performance and fall in the same. So one example that I would like to give is we can't drive on a road with our car just seeing a back view mirror, right? Similarly, just focusing on past performance is not the right strategy. You have to figure out what is the investment philosophy, what is the investment objective, and so on. Irregular reviews is one thing that you missed out. So it's like if you can actually rebalance and review your portfolios on a 6 months or a yearly review and so on, it would be a great way. Apart from that, it's like there are a lot of mutual funds and so that are there in the market as it's like small case too. It's like limited fund research and so on. So for more clarity, we need to have a proper source and an advisor that can help you guide through this pitfalls and so. And it's like assuming commissions are bad is also one thing that we see it as a pitfall because it's like we end up paying a huge amounts in ULIP and other insurance policies and etc. But we are not sure about an investment advisor of one person that could actually help us reach financial goals and help us in a portfolio management. So that would be some DIY pitfalls. Yeah. So yeah. So planning your finances allows you to write your own story. So that would be the main crux of financial planning exercise. It is the one thing that's going to give you more clarity about what's my asset allocation, what's my financial goals, how should I invest towards it, am I underinsured, am I paying too much tax, as per my total gross income, what's the right regime to choose, and etc. All these other topics that's going to be covered under the financial planning exercise. And planning your finances is going to help you out your own story. Yeah. So yeah. So planning, in short, can help you become wealthier because you're going to save and invest towards your financial goals, and yeah, reach each milestones down the line. So that would be from my end too. Yeah, actually, okay. There's one more bit. It's like getting a financial plan from a SEBI registered investment advisor. So as I said, it's like having a budget, setting up a budget. It's like, okay, let's say, suppose you are earning 1 lakh rupees a month, and let's say you are saving only 20% from that. So your savings ratio is just 20%. So lower the savings ratio, the lower the probability of reaching your financial goals. Higher the savings ratio, the quicker you will be able to reach your financial goals. So apart from that, being insured, it's like that is one thing that you have to focus on. Being tax efficient, it's like seeing it's like what tax regime that I'm falling in, making tax saving investments under old tax regime, and let's see it's like what is the best way to reduce your tax liability. And also one thing is diversifying your savings. We spoke a lot about the asset allocation part. And also if you have a lot of loans that you have, debt repayment strategies is one thing that we can focus on, and actually saving that money towards your financial goals. And obviously one thing is planning towards your future. Yeah. Yes. So also as Nakul also rightly said, it's like DRS allows the team to challenge umpire decisions, right? So one thing I would say is financial planning also involves making informed decisions, using financial planning advisors and research advisors and so on. To review your investment options is one of the best choices, and this is going to help you reach your financial goals. Yeah.
Awesome. Thank you for that lovely session, Vinayak. Diving deep into the instruments and how we can kind of go ahead with the implementation of the game plan once it's in place. So now I open the floor for any questions that you guys might have. We're happy to take them. We're happy to answer any and all questions that you have. Please do post them in the chat box. We shall take them. Okay, so I'll go for the Q&A question first. So it says, for long-term debt allocation, can we invest arbitrage MF or short-term or money market? Please advise. Sir, please do contact us. We'll be happy to help you. But for a long-term debt allocation, usually playing around with the duration makes a lot more sense than going for short-term or arbitrage MF, where these are meant for your emergency reserves. But do kind of contact us. We'll put our contact information on the slides so that we can kind of help you with it. Okay, I'll kind of go ahead with it. Scorching sun in Hyderabad, yes, sir, that is true. That is true. Small case, most of my equity investments are being done through small case. Why small case is no good? Any reason? Sir, simple, sir. Unlike a mutual fund, a small case is not very regulated. These are run by like self kind of proclaimed fund managers where you don't know what is happening. The churn is often very high. There is no proper regulation on what is happening, and the expense that you're paying here is also pretty high when compared to a standard mutual fund, which will anyway beat these products. So a mutual fund is probably a better way to invest than doing it in a small case. A small case as a product does not work a lot better than what a mutual fund does, because a similar product like a mutual fund does it anyway better than what a small case does. Small case does regular rebalancing. Yes, sir. Small case does do regular rebalancing. A mutual fund also does regular rebalancing. Everything inside a mutual fund is anyway tax free because the rebalancing is done in that case. What is the rule of US stock market investing and multi-asset investing? Thank you. So this is basically geography-wide diversification, sir. Because what we've seen is that over the last 20, 25 years, the US stock market is a place where good money is being made. Of course, Indian stock market is something where over the next 5, 10, 15 years, a lot of potential kind of involves. But having exposure to the US stock market at right valuations is very important, because getting access to their kind of tech ecosystem is one thing that is very, very attractive. 11 crore is too much on the higher side unless until someone wants to live a royal life post because I feel post because most Australians now I see don't have much and they're not Australian. Then why to scare future? So a few crores equity for is sufficient for this. Sir, again, this is something where it is depends on what you want. The calculations are just based on what Excel puts out because 11 crore corpus is based on inflation. So it is based on the inflation saying that let's say you require 1 lakh a month now, which is 12 lakhs a year. The next year we take into account 6% inflation, so this will become 13.5 lakhs. Next year it becomes 15 lakhs. For a normal person, this is not what actually happens. For a normal person, let's say from 60 to 65, 1 lakh is okay. After 65, then there is a big increase from 1 to maybe 1.5 lakhs or 1.6 lakhs. So if you're someone who 3 to 4 crores is content with the kind of living, you're okay with the income that it produces, then that is perfectly fine, sir. Of course, financial planning is something that you want to do.
So also I just wanted to add on the same query. It's like, sir, in financial planning, we assume it's like inflation at a higher side, 6% the best. And one thing is the returns that we take post retirement is going to be more on a conservative level. So it's like whatever extra corpus that we want to build, it can be a wealth corpus, it can be an inheritance, and yeah. So it's like similarly what Nakul said is right now the present value of the specific case strategy. So even if in that 11 crores, if you're just going to meet 50% or 80% is other thing. So even if you're going to meet 50%, you will be able to retire comfortably because there are a lot of avenues like systematic withdrawal plan. Because it's like in that, even if you're meeting 5 crores, where the requirement is 11 crores, the 5 years of your expenses, you can shift into debt fund and create a systematic withdrawal plan, where the remaining corpus, you can actually build it and compound it in the equity. So hence, it's like reaching the biggest corpus or the biggest target would be more on a bigger milestone. And yeah, that is just what I wanted to add to.
Awesome, super. How can we invest in gold mining? Sir, for long-term debt allocation, can we invest? So I've already talked on this. Please reach out to us, sir. We can kind of help you set up a long-term debt portfolio as well. Arbitrage and short-term or money market kind of funds work better in the short term. How can we invest in gold mining companies? Is there a mutual fund in India which invests in it? So yes, there is. But of course, we do not give out any recommendations as such. Gold mining is another place where we see a lot of potential. Do reach out to us. We will be very, very happy to kind of advise you on this kind of regard and handle your investments in this regard. But still nobody can make or accumulate 11 crore unless someone starts early after education. You guys make it possible. I see in good time, unlike I understand, sir. I understand your question, but of course, 11 crore is just an arbitrary number based on financial calculations. Again, it will depend on what you want. If you're someone where 3 to 4 crores or 5 crores is sufficient, then that is what all that someone needs. I'm personally someone where 7 or 8 crores is being a dollar millionaire is probably enough for someone to sustain themselves for a very luxurious lifestyle. But again, as Vinayak said, all it takes is one medical emergency where your health insurance doesn't kick in and a lot of your corpus that you saved up is just gone.
Yeah. So actually in the case study, we missed to add the calculation. So the main part was it's like, okay, let's say the expenses of that specific person or the investor right now is 1 lakh rupees per month. If that person is just able to save 50,000 for next 25 years and assuming a just 10 to 11% of return, they're easily be able to build 8 to 9%, 9 crores of corpus. So just with 50,000 of SIP where your 1 lakh rupees is expense right now, it's a present value. So yeah, that's something that's pretty achievable. But yeah, it would depend again from person to person. Yeah.
Awesome. What is the return we expect in short-term debt mutual fund in 1 year horizon? How do debt funds differ from liquid funds? Please allocate. Sir, debt fund is the broad category. Under this, you have things like liquid funds, short-term debt funds, money market funds, overnight funds, arbitrage funds, long duration funds, government security funds, things like this. So that is how kind of debt funds are a broad category, and liquid funds, money market, all of these are debt funds, but different types of debt funds where they hold different duration of securities. As for your previous question, what is the return we expect? Right now, a yield of 6 to 7 to 7.5% is a good yield to expect from money market or short-term debt funds. Risk of SGB investment against actual gold investment. There is no Well, there exists a risk that, let's say, 8 years later, your gold price might not be what you expect. The gold price might be lower because these are investments where they are directly tied to the price of gold. So that is kind of the risk that invest. But other than that, there is as such no kind of risk because it's being issued by the RBI, right? So it's a safe kind of investment. But of course, market risk is something that always exists. But whichever kind of avenue that you invest in gold, that risk is always going to be there. How to plan reinvestment of PPF corpus into mutual funds. Vinayak, do you want to take it?
Yeah. Okay. So suppose let's say it's like you have built a 15 lakhs of corpus, let's say in the PPF for last 15 years, and now it's a maturity. You want to diversify the same. So right now it's like how you can actually approach and invest in the mutual funds. There would be different strategies. It's like rather than locking it directly in one shot, there is something called a systematic transfer plan. So you can allocate that specific 15 lakhs of corpus in the short-term debt funds or another money market funds and so. From there, we can create a systematic transfer plan, and for next 20 to 25 weeks, we can deploy it on a regular basis. So that is one strategy that you can think of. And also it's like this is going to depend about your financial goal. If it is a long-term goal, then yeah, we can be a bit on aggressive when deploying and see whenever we have a market opportunity. So that is one thing that you can try out for your reinvestment of your PPF corpus.
So thank you for that, Vinayak. Guys, if you guys do have any other questions, please let us know. I do have again a question on a small case from Raj. Sir, basically with small case, the expense associated with these portfolios are quite high, sir. One more thing is these are highly concentrated portfolios where small case is just acting as a middleman. So if something goes wrong with this, again, the point of resolution, I don't know if it can be SEBI. I don't know if SEBI will step in. Of course, in that case, SEBI will step in. But yeah, in the case of highly concentrated portfolios, and if you're not in a bull market, then it can end in a very pretty bad way. So again, being optimistic is one thing, but being overly optimistic at the time where you're paying a lot as well as you have concentrated portfolios can be kind of a this thing. But again, yeah, I understand the small case is backed by Zerodha and stuff, but Zerodha is not the regulator. The regulator is SEBI, and often what SEBI says goes. But another thing to kind of think with small case is that unlike a mutual fund, where they have broad mandates, a small case has very specific mandates, and getting these mandates kind of correct at particular points in time is very important. So for example, if you invest in a small case that is kind of investing in a particular sector, you need to know a lot about that sector before you put money into it. So these are kind of things where you'll need to kind of be extra cautious with it. So yeah, so that is why when we have something like mutual funds which kind of does the same or even a better job in that aspect, we kind of stick with this mutual funds. Thank you for sharing this. Thank you, sir. Thank you for taking your time out to attend this. Thank you all for taking your time out to attend this. We still have few more minutes, so please, whatever questions that you guys have, please post them in the comments or the chat box. We are more than happy to answer them. I think we are done with questions. So even if you do guys have any other questions, okay, I just think one question about it. What if India also goes through long periods of underperformance like Japan? So maybe I'll kind of take this question before we close it off. So the 80s or the 70s, the decade after the kind of the Second World War ended, Japan experienced what is called as the miracle kind of century, where miracle kind of decades, where 20-30 decades Japan was exporting a lot of kind of industrial products, and their economy was doing really good. But after that, what kind of happened was the asset prices were kind of at a place where they were in a kind of a bubble, because the 20-30 years of euphoria is built on to that kind of a thing. And Japanese economy was at a place where they didn't have a lot of inflation in place. They always had a kind of a deflationary economy, where for a company to sell kind of its products at a higher price, some kind of inflation is required in the economy to it, so that if I'm manufacturing something for 10, I can sell it at 12 now, and the next year I can sell it at 13. But in a deflationary economy, I cannot sell it at 13, because automatically my competitors are going to come in. They're going to take that 1 rupee advantage from it, because there is no kind of inflation in place. But right now, what we are seeing is that Japan has started to experience inflation again. Prices are going up again. The yen is at again at a very very low point where the Bank of Japan is actually doing increasing rates to manage it at this point. There is not a zero interest rate policy or even a negative interest rate policy that is at place. So inflation is good, and Japan experiencing inflation is good at this point. Now, coming to India, with the next 5-10 years, we have healthy inflation now itself. RBI is managing it pretty good. With inflation going up, corporate profits are also going to go up automatically. So we are not in that place where that is there. Of course, over the next 5-10 years, there is going to be market declines. That's how markets work. This is not something that can be eliminated. But investing through this is what is going to enhance your returns. So that is how the Japanese kind of market compares through it. Next 10-15 years might be the miracle generation of what Japan kind of experience. That can be the case in India as well. Thank you for that questions. If you guys do have any questions, do drop them in the box. If that is not the case, then we can kind of close it. It has been a lovely session having you guys here for me and Vinayak. Thank you for taking your valuable time out on this Saturday afternoon. Hope the weather treats you guys better, and have a nice weekend. And most importantly, do watch the kind of do watch the IPL finals. I know we guys are not there, but anyway, have a good weekend, guys.
Thank you all.
Thank you.